From Monday the 18th of May 2026, you can now buy a home in the UK with just a £5,000 deposit. So what's the catch? Well, the numbers behind it are pretty brutal. So by the end of this video, you'll know if this is right for you or if it's a trap. I'm Afshin, a qualified accountant. Let's get into it. Lloyds Banking Group, which owns Halifax, Lloyds Bank and Bank of Scotland, just launched the same product across all three brands. And here are some of the key features. Now before we get into this is not financial advice, but this is simply just to offer up all the information possible so you can make the best decision for you. You'll see, as mentioned, the minimum deposit is £5,000, and this is for a property up to the value of £300,000, which means the maximum loan amount is £295,000. This would put you at a 98% loan to value. Now the rate is fixed for 5 years at 5.89%. There's no product fee, and you can take a maximum term of 40 years. You can borrow up to 4.5 times your income. So to borrow the maximum £295,000, you'd need to be earning just over £65,500 a year. So here's the catch most people miss. The rules on who actually qualifies are quite strict. So who qualifies? Well, at least one of the applicants needs to be a first-time buyer. Both employed and self-employed can apply, but you will need a high credit score. So if you've defaulted in the past, this may not work for you. And now here's the big one. You can only use your own savings. You cannot use a deposit that's been gifted by friends or family. Now what properties are eligible? Well, it can't be a new build, it can't be shared ownership, it can't be right to buy, and it can't be buy to let. So you're probably thinking, who is this actually for? Well, somebody who has at least £5,000 saved, a decent salary, and a clean credit history who wants to buy an existing home rather than a new build. Now that's a much narrower audience than the headline suggests. So before we get into a few scenarios, one thing the headlines seem to miss: the £5,000 deposit isn't your only cost. You'll still need between £2,000 to £3,000 on top of that. This covers conveyancing fees, survey fees, and land and registry, which you can see down here. But the good news is, anyone buying a property under £300,000 in England will pay £0 stamp duty. So let's run through a few scenarios to see what the numbers would look like. So scenario 1, buying a £150,000 property in Liverpool. So with a £5,000 deposit, this means you're borrowing £145,000. So your salary would need to be just over £32,000. Now we're going to compare two different types of loans, one 40-year term and one 25-year term, to see how that would affect the total amount paid over the term of the loan. So you'll see on a 40-year term, your monthly payment is £786, which means you're paying back £377,000 over the 40 years. Compare that to a 25-year term, you'll be paying £924. However, the total interest paid is £132,000 compared to the £232, which highlights the £100,000 interest saving over the lifetime of the loan. Now scenario 2, a £225,000 property in Birmingham. Again, with a £5,000 deposit, we'd be borrowing £220,000. You would need to be earning just under £49,000 to get this. And again, comparing the 40-year to the 25-year term. On the 40-year term, your monthly mortgage payments would be just under £1,200. So the total paid over the term would be just under £600,000. In the 25-year term, of course, your mortgage payments would be £200 more, but you would be paying £150,000 less in interest. So I guess the quick question for you is, what would you actually need to spend in the part of the country that you live to buy something that's reasonable? Well, let's look at scenario 3 in the outskirts of London and max out the loan to £295,000. As mentioned before, to be able to apply for this, you'll need to be earning just over £65,000. And in a 40-year term, that means your monthly mortgage payments would be £1,600. The total paid over that term would be £768,000. Just £473 of that would be interest. Again, if we compare that to a 25-year term, your monthly payments would be just under £1,900, but the total interest paid would be £200,000 less. Now, of course, this is just for illustrative purposes. You'd hope over the time of your mortgage you'd be reducing the terms and paying into it. The 40-year term is of course what makes the £5,000 deposit possible, but it's also what makes it so expensive in the long run. Now let's look at some of the things that the headlines aren't focusing on, the risks. So risk number 1, the negative equity risk. You're buying a home at just over 98% loan to value. That means if you're utilising the £5,000 deposit to buy a £300,000 loan, you own just under 2% of the home that you bought. If the house price was to fall by even 5%, you could owe more than your home is actually worth. And you would be a little bit stuck until the end of the first fixed term. The risk number 2, you're locking into a high interest rate. 5.89% is very high at the moment. For comparison, somebody with a £25,000 deposit would be getting about a 4.5% loan at the moment. Risk number 3, the 40-year term. Taking a mortgage over 40 years means you could be paying this off into your 70s. Risk number 4, the geographic limitation. The £300,000 cap excludes most of London and the South East. The average first-time buyer property in London is about £481,000. So unless you're buying in outer London or moving regions entirely, this might not help you. So what's the verdict? Should you actually use this product? Well, here's how I think about it as a qualified accountant. This mortgage makes sense if you can't realistically save a bigger deposit in the next few years, if your rent is already higher than the projected mortgage payment, and if you plan to stay in the property for at least 10 years. Also, if you're buying in a region where £300,000 buys you a decent home and you can afford the monthly payment with room for rate rises after the 5-year fix ends. This mortgage might not make sense then on the flip side if you could save more deposit in 2 to 3 years to get a lower rate, or if you're buying right at your income limit with no buffer. Of course, if you're in London where the cap doesn't even cover a decent property, this may not help you. It's not a bad product, it just might not be the magic ticket that the headlines are suggesting. The £5,000 deposit headline is real, but as we've just seen, the £5,000 is the easy part. Whether this is right for you depends entirely on which scenario fits your life. Hopefully this has helped. Hit subscribe for more no jargon UK personal finance. I've got more videos coming out soon, and I'll see you next time.